next, my conversation with Orlando Bravo, founder and managing partner at Thoma Bravo. Orlando Bravo, great to be with you. Great to have you on this morning. You're joining us, I know, from Miami.
Ed, thank you for having me. It's good to see you. You're looking great as always, by the way.
Well, thank you. I think the New York weather is doing me some favors by giving me a sort of gray backdrop against my nice blue. So look, let's start with Miami. I took the liberty of going on your Twitter feed this morning. One of your most recent tweets from a couple of days ago says, "Miami, it's the place to be!" exclamation mark. What is it about Silicon Valley that's become unappealing in the last year or two?
Well, look, for us, we love Silicon Valley. We still do. We are growing, so our San Francisco office is a lot larger today than it was 2 years ago. Now, we also love Miami. How could you not love the movement that's going here? A new tech hub is being created. People can be really entrepreneurial, and it gives a big opportunity for young future leaders to set their own mark. Also in a society in a way that fits them. They can do philanthropy in their own way. They can be leaders in the community. It's a lot more open to these young, talented adults, especially in tech.
And on tech, you and I have talked a lot in the past few years about valuations, and they seem to be getting higher and higher and higher without sort of ever slowing down to catch breath. I wonder how, as a private equity firm, therefore, what we traditionally think of as buying sort of cheap and turning stuff around and putting it back out, how do you manage in that environment?
There is no such thing as cheap anymore. There were only 2 times in our history, in our 22-year history of doing software buyouts and software investing, that in hindsight only, it was cheap. That was 2000 and 2001, after the first internet bubble burst. And then maybe a year and a half during the financial crisis, when it was still really hard to do deals because nobody wanted to sell companies. We were able to transact with a lot of public companies at that time, which we were fortunate to do. But really, especially software buyouts, it's really a growth industry. It's really a growth equity industry. It's a growth buyout industry. So you have to pay up to buy the best. And then not only that, you have to then provide big operational and value added to these companies in order to make the acceptable returns that our limited partner community needs for their business.
And let's talk about that, because when you say pay up by the best, at the moment at least, that means writing very big dollar checks, and therefore you have to go out and raise very big pools of capital. You guys, I think last year, closed your most recent fund at around $23 billion. You're out raising a new fund at the moment. How does that work when you are a smaller or newer private equity firm coming into the market? You can't afford to write these checks, and even if you can, you don't necessarily have the operational experience needed to turn these companies from, you know, expensive, decent companies into even more expensive, very decent companies.
So that's a really insightful set of points that you're making, Ed. Look, there are 3 significant barriers to entry now in tech buyouts and in software buyouts in particular. Number 1 is culture. A new entrant, culture is becoming the differentiator. As I like to say, culture is not the most important thing for us, it's the only thing. So as a new entrant, how do you set yourself up to fit what is going on in the market and the companies that you're trying to buy? That's a big deal, because now this is an established place. It's not a new industry to do software buyouts in. That was 22 years ago. The second big thing is operational expertise. The average publicly traded SaaS software company today, the average one loses money, and these are the best. So you have to have a set of skills and a history and a reputation for bringing these companies to 30 to 40 to 50% EBITDA margins in order to do the fundamental investing that our industry does. Those are 2 key ones. The third one is newer, and it's scale. It is very important to us to buy the number 1 player in each specific software market. You look at our deal with Proofpoint, a $12 billion deal. They're the number 1 email security vendor in the world. Why would a customer waste their time to invest or buy the product of the number 2, 3, 4, 5, 6 email security vendor when email is the main threat vector of companies? We're seeing customers then behave that way and going to the best of breed very quickly. Now, those best of breed players and those market leaders that we feel is where the world is going, those are now massive companies. So it requires big equity checks, and they're compounding at 20%. And that in itself is another big barrier to entry.
And we're seeing that not just in tech, obviously, but across really all of private equity in terms of the very, very large private equity players seemingly inexhaustive ability to go out and raise huge amounts of capital to write very big checks. I wonder, is there a case, or are we perhaps approaching an era when there is a case for there to be more regulation of the space that you would see in traditional corporates, whether that's looking at their deals on a sort of antitrust basis or indeed looking at a possible breakup scenario for some of these firms that just have too much power, too much concentration, and therefore are keeping other entrants out of the sponsor space?
That's absolutely the case. I mean, you're seeing big monopolies being built or establishing themselves even deeper in some of these markets. We do business-to-business software. We don't do social media. We don't do consumer. In general, in business-to-business software, most of these markets are heavily fragmented. Now, there are cases of companies that I won't mention their names that have monopoly positions because they give out all their other products for free in order to support something else. And that stifles innovation, because if you want to start a software company as a best-of-breed vendor and you face a free, lesser company in the market, it's kind of difficult to operate in. But in general, for us, when we look to sell a company, many of the new buyers of these large software assets are industrial companies that are looking to digitally transform their businesses, not only internally, but through M&A, and they need scale, and they don't have antitrust issues because they're not in the space yet. And that's a very attractive strategic buyer for us.
Thinking of regulation, another area that is obviously very hot at the moment is the SEC in their proposals or initial proposals to allow retail investors more access to private equity. It's been a topic discussed for years, this sort of how do you connect this mass affluence with private equity. They're keen to let it happen, but they said there needs to be better regulation, obviously better transparency about what retail investors are getting into. From where you sit, what should that look like?
Disclosure. Go back to the philosophy of the regulation, of the regulatory scheme that exists, and just provide more disclosure. Have the managers that are out there raising capital for retail investors provide all their numbers in many different ways, and just have proper disclosure, because I do believe, and we were talking about it before, that retail investors, the retail investor of today is totally different than the retail investor of 20, 30 years ago. These are extremely smart, highly educated, talented, in many cases young adults, and they want in the game. And if you don't provide access to private equity and venture capital for these great retail investors, they will find it in other ways in the public markets that regulators don't like either, like SPACs or other quote-unquote high-risk areas.
Well, then flip that round. Is the government doing too much to sort of mollycoddle retail investors and hold their hands, and therefore not giving them credit for what you say is that level of sophistication that's there?
I think the regulators are not giving the retail investor the credit they deserve for their sophistication. If you look at some of the strategies that have been used by retail investors, those could have been used by the big money managers, and they didn't. They have been innovators in the space in many ways. Once again, the profile of the retail investor is totally different than it was 30, 40 years ago. When I started working in 1992, what you were worried about in terms of the retail investor was somebody that looked like the Wolf of Wall Street, calling my grandmother and selling her some pink sheet stocks that you couldn't even find in the Wall Street Journal. This is a totally different set of information, totally different people, and they want in the game.
And how much do you think that's to do with the way social media and the way the sort of modern technology has actually allowed them to mobilize to do things like we saw earlier this year when the shorts were being sort of squeezed in a way that was not necessarily coordinated, but certainly carefully, it seemed like it was carefully orchestrated through social media platforms?
Completely. How powerful that has been. I follow some of these retail investors for fun, first, in social media, and two, I get some great insights from them. And the fact that the power of this distributed competing world, and the fact that they can reach a lot of people just so quickly and get a big following for making good investment decisions, that's a big deal, and that's a big change.
tell me, have you had any ideas from them that have led or will soon lead to a buyout by Thoma Bravo?
Well, not that much. Not, no, it's not that big yet, but certainly for my own individual investing, I get some ideas. And also for some of our public holdings, you get to see how the actual investor publicly out there gets to think about valuations and growth rates. And I think that's insightful.
I saw recently, obviously, your comments on Bitcoin. You've been very publicly bullish about it and about, indeed, crypto in general as being sort of future of currency. Talk to me about how we might see that intersect with your sort of business, your day-to-day business. I mean, is Thoma Bravo going to invest in the space directly? Are they going to allow LPs to give them money in the form of cryptocurrencies? How is it going to work from a business standpoint?
Well, look, first of all, we were one of the lead investors in the growth equity round of FTX, which is just a phenomenal trading platform. We believe it's the best in the market. We will be big players on the buyout side as this industry matures, especially around blockchain technology. In many cases, blockchain provides better use cases for problems that exist than database software products. And we are seeing this maturation, and we will be participating in it in a big way. To us, it's just the software market or the digital market just became a lot bigger, and it's providing a bigger opportunity set for us.
What does it look like in terms of the deals we could see you do? Are the companies that you would obviously go after for buyouts in the space, or is this going to be more like a venture capital model?
First, it's growth equity. That's where the market is for this category. And now late-stage growth equity for this category is becoming very feasible to invest in. I think in the next 2 to 5 years, it will move to great control transactions, and we'll be right there just like we were 22 years ago as one of the first software buyout firms in the world.
Another area you and I have discussed is SPACs. Obviously, you did the Thoma Bravo Advantage SPAC earlier this year. It's now de-SPACed through IronSource, which is now trading as a public company. The SPAC game has been somewhat sullied, I suppose, by abuse by some participants, or perhaps like too much energy too quickly going into the space. I know when we've talked about it before, you said you had hoped to do another SPAC. Is that still something that's in the works? Yes,
we will do now. Nobody likes that word. Nobody likes that term. The regulators don't like it. Now investors don't like it. So we for sure will call it something different, because it will be something different. I mean, we do believe that there should be great alignment between the SPAC sponsor and the investors, just like there is in private equity. Investing real capital behind it, being the lead investor in the PIPE, for example, which is something that we did in our deal with IronSource. We believe there should be a lot more transparency in terms of what are the returns of that SPAC sponsor, what do they look like, and there should be a lot more transparency in terms of how does that company perform versus the projections that they originally gave the investors. That should be disclosed in every quarter. That should be a requirement. So we feel that SPACs are one of the great financial vehicles for absorbing this wave of large software companies and tech innovators that are looking for alternative forms of financing. Now, it's also a great vehicle to combine the best of the liquidity in the public markets, the diversity of investors that you get in that process, and the best of private equity as well. And we believe we have a model for that.
But when you look at it, yes, a lot of the SPAC deals that were done did involve those kind of companies, but an awful lot also involved the kind of companies that were highly speculative, had sort of predictions that potentially will be met, but they were fairly ambitious, I think, to put it lightly. Is that going to make it difficult to go and do a SPAC in future, because people are going to look at it and say, well, you know, we don't believe the predictions, because the last time this was going around, people were saying it was going to achieve X, Y, and Z, and none of it was delivered?
Look, the SPAC is about who the investor is, who the sponsor is. That's hopefully also helping the company operationally, and it's a good partner. And the SPAC is about the company. That's what it's about. It's like an IPO. Would an investor value a company differently because it went public with this set of banks instead of with this other set of banks, or because it did a direct listing instead of not a direct listing, that's irrelevant. It's about the fundamentals of the company. Now, I do agree with you that the SPAC market shouldn't be for venture deals, because one of the advantages of the SPAC is that you can project your business, and projecting a venture company, no matter how good you are, is very difficult because you have no track record and history at that company of producing results and seeing where you're going to be in the future. Now, of course, venture companies go public through SPACs because there's the demand from retail investors and others that cannot access the venture capital industry anyway.
And I suppose that you need that narrative, which a lot of those companies seem to have to get the sort of early excitement. Let's just talk about IPOs before we wrap up. Obviously, we're seeing some of the other large private equity firms make their sort of steps towards going public. I think TPG is widely touted to be the next one out. What can we expect from Thoma Bravo in that regard in future in terms of, public company versus private company?
We love our private company status. We are one of the few large private equity firms that's 100% employee-owned, and we like it that way. It provides great alignment between us and our limited partners, and that is the fabric of how we built our business over time. And going back to culture, culture is not the most important thing for us. It's the only thing. And our ownership structure allows for that culture of providing and promoting the next generation of future leaders. That is really what drives us.
But couldn't you maintain that and keep the culture within the firm whilst being a public company, whilst having, that public equity, which potentially would be good for the culture and good for the partners?
You could. I think you make a really good point. You could. The way we think about these decisions is decisions that are reversible, we make very quickly, because if we make a mistake, we can adjust. Decisions that are irreversible or may take a long time to reverse, we really take our time and are very thoughtful about it, and that's how we're dealing with this staying private versus going public point of view.
And let's just end where we began in Miami. You are opening this new office very soon, I believe, in Miami. Is the plan over time to migrate more and more of the company to Florida, or do you think San Francisco is going to remain the sort of the home base?
San Francisco is growing. We're growing. San Francisco is growing a lot. We really love it there. And we also love Miami because going back to culture, it was very important for us that we continue to hire diversity of thought and diversity of talent. Having an East Coast office, especially in this new growing and exciting tech hub, is adding to our culture significantly. We've been able to hire some great people, and we've been able to really promote, once again, future generation leaders and now can lead in different ways.
Orlando Bravo, great to have you on the East Coast. Always lovely to get your thoughts and your wisdom. Thank you so much for joining us for this conference, and speak again soon.
Thanks so much. Good to see you, Ed.